Welcome to this Business Tax Roundup for this month. My name is Dean Wootten. First up, it's the well-publicised case of Gary Lineker and his ex-wife Danielle Bucks. Now, Gary Lineker provided services to the BBC and BT Sport through Gary Lineker Media, and that was a partnership with his wife at the time. Now, Danielle was entitled to a fixed sum of £30,000 per year, but this case wasn't really about her. It was about Gary Lineker. Now, for 13-14 to 17-18, he reported his partnership income on his tax returns. HMRC sought to charge PAYE and national insurance, claiming his work fell within the Intermediaries legislation. Unusual, because we normally see that when you trade through corporates and the personal service company regime. Now, the couple appealed. Now, it's fair to say that IR35 can apply to partnerships, as stated in Section 49.3 of ITEPA. It is quite unusual, but it can apply. Now, Section 49.1b states that the intermediary legislation does not apply in partnership situation where the services are provided under a contract signed directly between the client and the worker. Now, thankfully, or maybe good advice, each contract had been signed by Gary Lineker rather than his wife at the time. Now, Section 5 of the Partnership Act 1890 gives the partners the power to bind the firm, acting as principal and agent, so him signing it was absolutely fine. Now, when Gary Lineker signed the contract, he did so as principal, thereby contracting directly with the BBC and BT Sport. Now, because he was effectively the worker HMRC were trying to target, and the client was BBC or BT Sport, the intermediary legislation could not apply, simply because the legislation specifies that it cannot apply where the services are provided on a contract signed directly between client and the worker being Gary Lineker, the client being BBC. Very fortunate or good advice that Gary Lineker had signed the contracts. Had Danielle signed the contracts, then it would have been a case dependent on IR35 principles, i.e. control and all the other bits and pieces. But they didn't get that far because he was the one that signed the contracts. And the legislation specifically excludes that from applying the intermediaries legislation. Another intermediaries case, this is the Eamon Holmes case, and his company's Red, White and Green Limited. Now, between 11 and 15, he worked as a presenter on many projects, mainly This Morning for ITV and Sunrise for Sky News. And the appeal concerned his work for ITV and covered the tax years 11-12 through to 14-15. HMRC issued determinations and notices on the basis that he was caught by the intermediaries legislation, IR35, to most people. And these were upheld, these determinations upheld by the first tier tribunal. Now, the company appealed to the upper tribunal, and they argued that the first tier had erred in its decision, both in relation to control and when considering the whole picture. If you think back to the first tier, it was very much focusing on editorial control, and that was a really big factor in the first tier tribunal decision. Now, the company argued that too much weight had been given by the first tier tribunal to how the role was carried out, and not enough focus had been placed on what the services were performed. Now, the company argued that editorial control was not the deciding factor. Eamon Holmes had a considerable amount of autonomy, apparently, over the way in which he provided his services. He could decide when and where he could prepare for the programmes, and when he arrived and left at the studios. And you look at that and you kind of think, well, that's not really a lot, is it? If that's all he can actually do. And the rest of it is subject to the editors, etc. Now, they also argue that looking at the bigger picture, certain factors have been disregarded. In particular, the fact that he was in business on his own account. A lot of the cases that go in the taxpayer's favour, there's a lot of other contracts. And that does seem to be a significant factor. So in this particular case, they said, well, the first tier didn't consider that. Now, the upper tribunal stated that control included control of what was to be done, as well as how, where and when. So editorial control looks like it's quite important. Now, the upper tribunal found that Eamon must comply with the industry regulator, which was a highly relevant factor. And he must present This Morning when and where ITV chose. He must carry out promotional work as and when reasonably required, without further payment. As far as the upper tribunal are concerned, the first tier had reached a valid conclusion based on the evidence presented. And the first tier had not erred when painting its overall picture. They had balanced all the factors considered to be relevant, and they had reached the right conclusion. Furthermore, Mr. Holmes did not display any of the characteristics of being in business on his own account. A lot of the other presenters have done that, but Mr. Holmes didn't. So, unfortunately, that was another factor against him. Furthermore, there was no real ability to increase his profits from his work. Say, by doing a good job, getting his contract renewed, he didn't really have any economic risk like you'd associate with, let's say, a bona fide self-employed person, which is fundamentally what that test is for IR35. Either it wasn't for the company, would they be employed? So you're trying to look at those self-employed factors to make sure that you're not caught by the intermediaries legislation. So unfortunately for Mr. Holmes, the appeal was dismissed. Next up, we're looking at a case concerning share activity, and it was a client that was dealing in shares, making losses, and was trying to claim that his losses were trading losses, and he can offset them against other income. So I'm sure there's a fair few people in that boat. Whether they can get their losses at trading losses is another matter, though. Now, Mr. Henderson had bought and sold shares for a number of years in his personal capacity, and he just treated them as capital transactions. He retired in January 16, having inherited a substantial sum, and bought and sold shares through a fund manager, making execution-only share transactions. Now, Mr. Henderson was not a registered or regulated trader. He did not transact on behalf of third parties, and he held shares for up to several months. So not your typical trading in shares type client. Now, Mr. Henderson made a loss in 15, 16 and 16, 17, and he claimed loss relief on the basis that the activity was carried on in a non-active capacity. So he couldn't demonstrate that he spent more than 10 hours a week through the tax year. So he did have his relief restricted, the sideways relief restricted, and he could only get up to 25,000, so he obviously made quite a substantial loss. So he restricted it to 25,000. By May 17, he decided that the income from his share transactions were not enough to support his living costs, and he took up employment. Now, by the 5th of April 18, he'd sold all but 3 of the shareholdings, and obviously there was quite a lot of losses around at that time. Now, HMRC he denied his losses on the basis that what he was up to did not amount to a trade. But if it was a trade, it was not carried on commercially. Now, Tribunal looked at this and they said, well, the badge of trades has limitations. But the relevant badges could provide a useful framework, the background, for their decision. And the first tier found specifically that trading on average 1 trade per week was indicative that the activity was not trading. A lot of traders make multiple transactions per day. He was making 1 trade per week. Now, the 1 to 2 hours a day spent fitted around other activities, so presumably he was researching, etc., but only about 1 to 2 hours a day. And that was more in line with managing an investment portfolio. What he did was not carried out in a planned or organised manner. Furthermore, a serious trader making losses, they would have changed their approach. He didn't. So standing back and looking at the overall picture, Mr. Henderson was not trading. He was managing his investment portfolio. And that pretty much kept the old treatment as he treated it before, which was capital. He was just doing pretty much the same activity, but with more money. So it's still capital. Very hard to get that trading label. I'm sure there are a lot of day traders that could possibly meet that these days, but they may not have been that successful recently. So you may get some clients that are day trading, trying to argue that they're a trade, they've made losses and they want to offset. Now that is not the same as this one. This one, he wasn't day trading. He was just 1 transaction per week. That's not a trader. Right, moving on to VAT. First up, we've got Fareham College. Now, Fareham College was a further and higher education college that operated a training restaurant for its catering students, a hair and beauty salon for its hairdressing students, and a performing arts centre for its drama students. Now, services were provided to the public by students through the restaurant, through the hair salon, etc., to gain practical work experience while studying. And between May 11 and April 15, the college had accounted for output tax on those supplies. Now, in July 15, the college sought a repayment of nearly £70,000 of output tax on the restaurant income, on the hairdressing income, on the ticket income from the performances. Now, they argue that their supplies were closely related to the provision of their exempt education, pretty much in line with the Brockenhurst principles. And that made them exempt under Item 4, Group 6, Schedule 9, i.e. closely related to the educational service. Now, HMRC's view was that the basic purpose of the restaurant, etc., was to obtain additional income in direct competition with other commercial businesses, and consequently the VAT exemption did not apply. Fareham College appealed. Now, HMRC's stance, and the first tier was obviously looking at that, was that Item 4 should be interpreted in line with Article 134B of the VAT Directive. Now, the VAT Directive at the time was directly binding on the UK. And you would argue that it still is, even post-Brexit, because per the withdrawal agreement, nothing should have changed. And exemptions are a mandatory provision. So therefore, our law came from the VAT Directive, and our law hasn't really changed on exemptions. So this is relevant before Brexit, after Brexit. Now, Article 134B excludes exemption for these close-related services, for example, where the purpose is to obtain income through transactions in direct competition with those of commercial enterprises. Now, the main purpose of the restaurant, in the first tier's mind, was not to obtain additional income. It was to provide training for the students in a realistic working environment. It did operate at a loss, which is a major plus in this area, because if you do make a profit, it's much harder to argue that you're not obtaining income, etc., in competition with those of commercial enterprises. Brockenhurst, for example, made a loss on their restaurant. As far as the first two are concerned, the restaurant income was exempt. Now, no evidence was submitted in relation to the Performing Arts Centre, and the evidence supporting the hair and beauty salons was inconclusive. I'd say it's probably more leaning towards the business, because the hair and beauty salon, they didn't just operate in term time. It wasn't obvious that it was a training salon. There was a lot of fully qualified hairdressers there. So it doesn't appear like it's within the education exemption. So I think the Performing Arts was lack of evidence, but the hair and beauty salon, it was more to do with what was there, was more indicative of a normal business. And if you're a normal business, unfortunately, Article 134B kicks in and the exemption is restricted. So those supplies, the hairdressing income and the ticket income, did not fall within the exemption. The restaurant income did. Next case is concerning time and supply, really. Now, this was the Prudential, obviously quite a large, partially exempt business, and they received investment management services from a group company in return for a performance-rated fee. Now, in 2007, Silverfleet Capital Limited left the group and ceased providing those services to Prudential. In 14 and 15, the benchmarks for the performance-rated fees were reached, and that triggered the invoicing of a £9 million fee. But this was after the company had left the group. Now, you've got to remember that Prudential are predominantly exempt. So this was a big kerfuffle about whether there should be VAT on the fee. Because if there was, obviously Prudential are not in a great position from a recovery perspective. HMRC argued that there was a continuous supply of services, with delivery taking place when the companies were part of the VAT group, and invoices issued and payments made after the supplier had left the group. So consequently, VAT was chargeable on the fee when invoiced and paid. I presume Prudential were trying to argue that it's a single supplier of services, and that was when we were in the group, and that's no VAT on the invoice. Now, first tier ruled in favour of the Prudential, and HMRC appealed to the upper tribunal. Now, the upper tribunal thought this was a continuous supply of services, and the tax points were triggered on invoice/payment, and that was when they weren't in the VAT group. So unfortunately, VAT was chargeable because the invoices were raised and paid after it left the VAT group. Had it been whilst it was in the VAT group, obviously the group provisions apply outside the scope, and you avoid the VAT cost in Prudential. Next up, we'll look at, I think, quite a common situation, and it goes back to the 5% temporary rate on admission to certain attractions, certain cultural events. And at the time, I can remember there's quite a lot of people or businesses trying to say the 5% applied to their admission income. So it's quite a good one to look at from that perspective. Now, in 2009, so way back, way before COVID, the company's business was described on the VAT1 as other personal services not elsewhere classified, with specific narrative put in the application, provision of driving lessons off the highway for under 17-year-olds. Now, these lessons were generally carried out on private land, large car parks, exhibitions, etc. Now, during COVID, the temporary 5% rate was introduced for admissions to tourist attractions. Now, the company asked HMRC to comment on whether their income fell within it. And the response from HMRC was pretty much understandable. It just said, look, there's guidance, read the guidance. So the company, therefore, read the guidance, and they thought it was fell within what they were up to. And now, to make sure they were consistent, they changed the wording on its website to read driving experiences for the under 17-year-old. They submitted a VAT 484, changing its trade classification with HMRC. They even changed their SIC code at Companies House. And what they were trying to do was to make it an attraction, or fall within the same banner or group as like circuses and fairs, amusement arcades, etc. So not amusement arcades, but fairs, circuses and attractions which have lots going on in them. And they then charge VAT to the customers at 5%. HMRC didn't agree, and they issued an assessment treating the suppliers as standard rated, and the company appealed. This has obviously been a direct cost to the company, because it's unlikely they're going to be able to go back to their customers and say, ever so sorry, charge you 5, should have charged you 20. Can you give us an extra 15%? That's not going to happen. So this reduced rate during COVID, suppliers must fall within Group 16 as Schedule 7A to get the 5% rate, and they must meet 2 criteria. The supply must be a right of admission, and in addition to that, and you must have both of these, the venue or event must fall within this provided in Group 16 or be similar to that. Now, these supplies were not just for the right of admission. They included the use of a vehicle with supervised tuition. The main supply was driving tuition. Okay, there was no tests, but that was the main supply. The child was being taught how to operate the car, enabling them to drive safely, etc. So it wasn't really like an admission to a fair or an admission to a circus, which the 5% rate did apply to. So let's have a look at that events and venues within Group 16. So you've got shows, theatres, circuses, fairs, amusement parks, concerts, etc., etc. Now, the company argued their activity was very similar to those provided by a circus or fair. The first tier disagreed. They said, well, both a circus and a fair offer a range of transactions and amusements once you're in the event, once you paid your admission. A customer's purchased an entrance ticket is able to wander freely around. And now the company's offer was a specific pre-booked experience in a fenced-off area. The customers expected supervised tuition. They weren't just paying to get into the car park, for example. They were paying to be taught. And because of that, the income was not subject to the 5%. For starters, it wasn't admission income. You were effectively paying for a lesson. And secondly, they didn't even need to consider the second test, but they went on to it. The actual event itself is not one of the events that could be covered by this 5% rate. And I'm sure there's many other cases out there that have had the 5% rate applied. And when you look at it, they're not strictly admissions, or they're not strictly the right type of event. Well, that concludes the Business Tax Roundup for this month. My name's Dean Wootten. Thank you for listening.